So what we'll do is we'll do a little bit less formal report back than what we did before. So we'll just gather around the tables one after the other. And whoever wants to present what they came up with, if you can just stand up so we can capture you on video. But otherwise, we'll be just standing around. Yeah? And we'll just, yeah. So let's start here for, yeah.
So we were looking at life insurance, if you remember, which led to this very complicated and rather messy diagram. So we took this diagram, I understood how it worked, and said, right, what are the problems? What are the pain points that consumers have? And not necessarily for life, but generally for kind of general insurance, so for consumer lines. And the key issues we all felt had, we've lack of knowledge about the insurers and whether they actually will pay out when we need it, what I'm covered for, or the small print. How to access my insurance information. I mean, you've just had a flood, and by the way, your insurance papers were in that box, which is in the basement. It doesn't look like much. And also understanding whether actually the relevance of insurance. Do I need that extra cover that is being offered by the TV company when I'm buying my TV? Or actually, is it already covered by my household or other insurance that I've got? So in summary, it's really kind of about transparency and trust and having something incredibly simple. So looking at that, what we were effectively looking at, so well, why is it that it's so complicated? And Mike kind of made it very kind of truthful assertion, which is actually the whole industry is based around products being shoved to consumers rather than what does the consumer want and then find the products which are relevant. So the idea here is as a consumer, you'd fill in a form. So what insurance do you want? What do you want to insure? You know, I'd like to have my bicycle, my TV, my households. Yeah. So and then you maybe go into the detail for household and maybe in the detail for car. What is required for them to make their assessment. And then you'd see there and then what pricing it would be. So how much would I need to pay for all those things I want to cover? Oh, and if I decide I don't want to have my household because it's a bit expensive, how does that impact my pricing? So it's really about understanding that transparency in terms of pricing and also thinking about, well, why does it have to be on an annual basis? You know, companies have kind of insurance terms which are several years. So why can't I have a price? Because thinking about what you wanted was peace of mind. So how about the same price you're going to have for the next 5 years, you know, that you're going to be paying? Bearing in mind that when you are taking out insurance, it's meant to be for a risk in 1 in 75 or 100 years. So surely if you have one claim in the next 5 years, you're pretty much in the stats, rather than necessarily you're an aberration. If you're having 2, then suddenly your risk is different, and therefore it should be assessed differently. So it's about rethinking about the kind of the duration of the contracts, but it's also the terms. One of the things which needs to be brought back down to is you just need to have your terms on a single sheet, ideally in a paragraph. You know, anything which is in your house is covered. Household insurance, household contents, and not have all these kind of, well, you know, if it's kind of left behind the left door of your kitchen, and it's not covered anymore. So those are kind of the key things about, you know, if you kind of visualize that kind of that consumer journey. And the key is actually making sure that it's simple and the application is relevant. So, and that means also thinking about when I go out and buy my TV, is it covered by my present household insurance? And so it would be about making sure that you've got a system which allows you to kind of assess that. Now, we kind of explored kind of ideas of how you can effectively have data of what you're buying to actually be kind of linked in an intelligent manner that you can actually be popped up saying, do you want this to add this to your insurance policy when you've purchased an item? So if you think about all that, then actually it becomes super simple because you don't need all these intermediaries. You're basically just online. directly to the underwriter, who understands what the fundamental risk is and can price it, and can give you kind of a live version of what actually the pricing should be depending on what products you want to have. So all the issues that were raised about an insurance company wanting to broaden out scope and so on, well, that's just, it's there. You're actually solving the fundamental problem that the consumer has. And it's a kind of self-service basis. Then thinking about how claims management, and that's something where we kind of, what would be good to then kind of explore is how you, and I suppose, kind of a further discussion, but is understanding how you could actually be kind of claiming yourself. And there doesn't need to be somebody kind of checking whether it's right or not, because remember, your pricing is clear. So you know how much you're going to be paying, and you'd be able to say, okay, so if I'm going to claim on this, on my insurance, yes, I'm going to pay an excess, but how much is my premium going to be next year? You know, and does that affect my premium going forward? So actually, is it in my interest to be kind of claiming or not? Well, maybe not. So that's why the whole kind of duration of the contract has an impact, because you can then have much more interesting kind of innovative ways of actually serving the whole value chain to effectively serve the consumer and foremost, rather than the products pushing, which is what's presently being done. So that was our idea. I think the additional costs we do have, though, as we take out many of the other ancillary costs, is a lot more tech development. There you go.
Any additions to this?
Dylan mentioned this one, but just to highlight it, because I think it's quite important, and it was an example I had recently. In terms of transparency, one of the things that insurance companies know, but you don't get, and I found this recently, is impact analysis. You call them up and say, I've got a claim because it's flooded. What is this going to mean next year? And as I've had a couple of examples, we say, oh, that's a different department, so we can't tell you about, you know. Whereas if you take a sort of grown-up step back, they've got all the data. They can say, actually, that's not going to make a difference, or do you know what, if you claim for that, it's probably going to double it, or whatever. Anyway, impact analysis. Again, it's data that they can provide to the consumer, and that's really quite useful.
Yeah, so I will add actually one more component to your type of things that the consumer may want to know. Very few consumers are sufficiently educated to know what their risks are. So you can even think of extending this to a point where the insurance becomes your kind of, regular checkpoint where you go and you have a discussion about what are your risks. So it's
Yeah, so we did talk about that, didn't we? So we talked about, okay, how can you engage with the customer kind of here to find out enough about them that actually you're prompting that two-way discussion to happen at the start of the policy. Exactly. And as the year goes on, and we got on to talk about, okay, as people go through life changes, they buy houses, they have babies, whatever that is, how can you collect that information throughout the policy lifetime, be that a year, 2 years, 3 years? So actually you're prompting that customer to think about where they need more or less cover. And we got talking about Facebook, and is that a bit creepy? Or, is it creepy if you're monitoring someone's Facebook or Twitter feed to know they've got married or had a baby? And we think that there's other ways of potentially looking at that through using data collection methods that the customer controls. And it's kind of going a bit off topic, but we had quite an interesting discussion about, well, who owns your data? And actually, should the customer be in control of who has that data, and actually what they share with the insurer, and would insurers be willing to sort of sign up to that? So, yeah.
Liz was also mentioning about the idea, like, Amazon, they say, well, people like you have actually kind of taken out these type of insurers. So, you're kind of the mid-20s and you're kind of doing consultancy. Well, typically you're living in a flat in London and so on. So we've got an idea what your profile is, and therefore saying, well, these are kind of the options we'd like to suggest in terms of what you'd like to be maybe covering.
Just using that customer fit.
super. Yeah, thanks.
Very good. I hope you haven't given too much away.
Hello. Hi. So, as a reminder, our realm of insurance was big ticket risk. So, insuring an oil rig or a factory or something like this, which at the moment mostly goes through something like the Lloyd's reinsurance market. And so it's different from this sort of very large, distributed, predictable risks. And so proved a really fertile ground for discussion. And when we were looking at how to disrupt this, one of the things that we looked at was, what do the customers want? What are the things that we can give to them? And I think we concluded two main things are reducing the cost, so reducing premiums, and being able to facilitating the insurance of uninsurable risks. And there were other things around sort of service and mitigation and assistance in disaster situations and so on, but those are the two that we decided to focus on. And we, after speaking about a number of different ways of trying to achieve that, we decided that probably the one that would get the most traction is securitization of insurance risk. So at the moment, everything kind of goes up the food chain and arrives with the reinsurers, who are experts in assessing these risks. But that process is not that sophisticated in many ways. And I think earlier it was described by someone as often finger in the air. You know, what does it cost to insure this chemical factory in Kazakhstan? How many have we, where's the data table on that? It doesn't exist. So, but there's probably a smarter finger out there in the world somewhere. I think someone who knows more about Kazakhstan or chemical factories. And how can we access that? And if it probably doesn't sit in the coffee shops and the bars around the Lloyd's building. But if you were able to securitize insurance risk, and whether it's across many, whether it's widely distributed within a single security, or whether it's actually quite specific, so it's almost like a catastrophe bond, where you get insurance on an earthquake in San Francisco. What you would do is you get closer to a perfect market. So you have much more perfect, you have better information. So somebody who is an expert on whatever it is, the specific risk that's being insured, is able to say, well, I'm going to bid up the price of the bond, therefore reduce the cost of premiums. So that achieves our lower premiums. Also, things which would not otherwise be insurable, again, somehow you access capital that's willing to take that risk by being able to wrap up insurance into a bond, which needs to be tradable somehow. So we're going to set up that exchange.
That's fantastic. That's really interesting, yeah.
You're creating a secondary market.
And
You're creating a secondary market, basically, for the insurance by creating a bond.
Correct, yeah. There has to be a secondary market, exactly.
So what role actually the insurance company will play in this? Which pieces would be part of the business of the insurance company?
Yeah, so that we kind of struggled with. Generally we were trying to see where is the advantage for the insurance companies. One possible advantage, and I think we need a better understanding of the regulatory environments and so on, is a reduction, is higher capital efficiency. So if you're able to, you're sourcing capital more cheaply, or you're having capital reserves, which are actually other people's reserves. So if the catastrophe occurs, then you get to keep the face.
I mean, one of the common objections, but constraints on people setting up their own insurance company is a huge amount of capital required. Mm-hmm. So this is an alternative to. So this is one way that you can achieve the insurance, but without having to set up a huge amount of capital to set up an insurance company. So it's a good trick, basically.
Yeah.
It's a good disruptive technique. Apologies to those of you who are insurers. but it's a good idea. It's a good idea because it allows you to.
If you're an insurer, it's just reducing your reinsurance premiums. If you're a general insurer, right?
So is the return variable dependent upon the risk? So basically, if the risk happens, mm-hmm. you might not get anything back, or if it doesn't happen, then you get a lot back.
So I think bonds could be structured in a variety of ways. One way might be that if it's a single event, if it's a single risk bond, then if the factory burns down, you get 0. So you buy it at 95, it redeems a year later at 100. If in that year the factory burns down, you get 0. So that would be a sort of a digital, a binary situation. You could have, but if it's across maybe 1,000 factories, maybe they're correlated or related in some way. Maybe they're not. The more correlated, the higher the risk, obviously. But then you'd have a much higher expectation of some loss. There would almost always be some loss, but the belief, depending on the assets underlying it, you'd never have a 100% loss situation. Obviously, there are parallels with the mortgage market, and there's So I guess there's lots of lessons that can be learned there about risks, about agency, and people who are originating not carrying any of the risk and not having proper information flows and so on. Transparency.
And how big is the systemic risk created by the pinch point of the expertise of the person who does the packaging into a securitization, right? You were saying there is an expert in those risks, and they are the ones that help package it into a security that's sold on. So if that expertise is wrong, then it's passing that error into the whole of the market and introducing some wider risk to everybody, isn't it? That's essentially similar to what happened in 2007.
But when you could have kind of a pool of experts in a space who could actually come to an agreement. I mean, it feels to me that it's more kind of
I think
a problem to be solved. Yeah.
For example, the credits, when you had the credits when the people are actually betting on the rates, it could work similarly. So you would have experts who just bet on the levels on the actual bond. So that's a potential option.
And I think one of the ideas behind this, one of the hopes, is that it's different from the mortgage situation, for example, in that was the end where you've got hundreds of thousands or millions of individual risks, and there were all sorts of assumptions around correlation or lack of correlation between default within houses in Florida and so on. And there was very little transparency from the 100,000 homes underlying that bond and the Landers Bank that ended up buying it, or whoever it was. Whereas we've spoken about something which could be at that end, where you have 1,000 factories wrapped up in one bond. But I think you could also have situations where it's much more of a binary risk, so that then actually what you're doing is you're enabling the expert in, I don't want to use the Kazakh example, the flood risk for a particular bay in Norway. So let's say you're doing some new drilling, and this bay in Norway, maybe somebody knows that actually the flood risk there is kind of like a microclimate, or not climate. Even though you've got 100 data points saying that the risk of catastrophe in a Norwegian oil field is tiny, but maybe there's an expert who knows that actually, or they've got some access to data from satellites or drones or something. It facilitates or encourages, it motivates this. Someone to say, actually, I know that the risk is lower than people are pricing, so I'm willing to buy that bond for higher. And so I think actually the risk expertise doesn't necessarily now sit in the insurer, it sits with the capital. So you have lots of bespoke investors. And yeah.
It's a key point. It's a key point, a very key point. Well, thank you very much, Mark. It's a very key point. It's a very good point.
Our canvas is very empty, but a lot of work went into it. First off, we basically started just thinking about what areas we're interested in terms of disruption and where we might potentially sort of turn our focus. And we had sort of some ideas, and then we asked the question, look, is it a scenario that's broken, fundamentally broken and ripe for disruption, or is actually it's sort of fairly sound and we're sort of trying to find a problem to solve? The two sort of killer things by Robin, our insurance expert, he felt actually it's a very high cost of some intermediaries that actually provide very little value. And he said the other point was this kind of, he calls it an arms race and the sort of gamification amongst the insurers themselves. And actually there was a third thing, which was a kind of, on the sort of trust scales, actually apparently insurance is actually beneath real estate agents, which surprised me. And so it was this sort of systemic combination of a sort of like PR, 20 years of PR based on price, and sort of, the cost of fraud and, how that's accounted for in the policies, and sort of this sort of industry sort of approach to selling insurance that's led to this sort of confidence of lack of confidence and trust. And it wasn't trust around the sort of running and solvency of the companies. It was almost like bad perception or PR kind of thing. So those are the sort of big ticket items. And actually then what we talked about is, we had this idea of complexity, is those sort of things. There's an underlying complexity in actually the insurance market that we don't feel the end consumer is aware of or appreciates. And there was a book Mella gave to me to read, which was Resilience Thinking. And there's a very simple example, is if you think about a pond, and the pond is in a natural state, and there's a forest here, and there's a farm here, and it sort of is, there's this ecosystem. And then, you know, the forest, there's trees in different stages of growth, and there's different birds eating other insects, eating other things, and the farmer's growing his stuff here. What sort of happens is this sort of micro optimization for productivity. You know, the farmer is actually, reducing trees, expanding the farmland, aggressively using chemicals. That's running off into the pond. The forest is managed, pesticides, the trees all grown in sort of the same cycle. They're all cut down and replanted. And what happens is the pH levels and the ecosystem of the pond then changes one day. Fish die and the algae comes back. That's all fine, but when you come to undo it, it's not a simple matter of just, even if you revert the other things back to how they started with, the overall system has moved into a completely different way of operating. And it's almost like you need orders of magnitude change around it just to bring it back to its initial resting place. Actually, we think that is completely accurate description of what we've seen in the insurance scenario, which is a sort of local optimization of these policies, because the price comparison and brokers are competing on policies, price differences of 1 and 2 pence, 1 and 2 pounds. And what's happening is, to get at the top of the league tables, you're getting sort of competition at the sort of pricing level, and what it's doing is blowing out the complexity of the policies. And so the end user sees more and more complex policies for very little financial change, gamification by the actual, compare my insurance policy. So that was the background. And then basically, we then started looking at 2 scenarios. The first scenario that we all like to look at is this idea of a consolidated view of insurance products. And the reason this was suggested is actually I see there's an intersection of 3 trends coming about. And the first part of it was, we've seen in banking already access to bank accounts. And that happened before the individual banks signed up to share their account information. It was done through screen scraping, and there was, all sorts of legal back and forward. But it's been in America now 15 years. They can do corporate access, consolidation of accounts now at the bank level. So that's already been done. And then on top of that is, there's forecasting tools in Treasury, which takes a consolidated view of the cash and looks at it over a period of time. Is it cyclical? Is it to do with business conditions? Oh, there's a hole in the cash flow here. Actually, you need this kind of FX product to fill the cash flow, and we've gone and got you quotes. So that's already out in the marketplace. And the other one was, some banks and other places, based on their trust reputation, are starting to now provide secure document storage for things like Bitcoin, because they are the trust provider. And so you see them as a sort of, safe storage for other non-banking playing on the trust. You take those 3 things and you look in the insurance industry, a startup play would be very simple, such that, you receive all of your insurance documents via PDF now and email, because it's a nice cost efficiency. You just upload them into our portal, and we'll get our team of Indian guys or Polish guys or wherever's cheapest now to just manually enter in the details of your policies into your one single consolidated view. Now we can see all of the expiry dates. We can see the actual amounts they're paying. We can see where it's going to. We can proactively go out to the market and receive quotes from insurers. We've actually cut out the compare my thing. It's not compare anything. It's just something's coming up for renewal. That's pretty basic, right? Because the next extension is, imagine it's not just a startup. The bank decides to actually offer this as a portal because they're already logging in to do their online banking anyway. And it's a natural extension of what they already have. And then wouldn't it be cool? Because the bank actually sees the cash flows. So they can tie up the cash flows. And actually they can look across their customer data and say, well, we know for a fact that other people in your situation have got insurance policies with the same insurer, but they pay a lot less, maybe because of the time they took it out. So they can start being proactive. And then actually another idea was, what if there's a mobile app a bit like we had the suggestion about filling in the form about I've got a bike and a car. What if I just download a mobile app and I start documenting a week of my life? I take photos of my kids, my wife, my house, my car. The app is location enabled. It knows where I live. It knows where I commute. Photo of my bike. It says, looks like you're going into Virgin Active today. Is that correct? Yep. And it kind of chronicles all of this stuff, combines it with what your actual policies are and what your payments are. They're in a very strong position to start providing proactive advice and suggestions. We know that basically you're paying the top 2% of all premiums for Virgin Active on Oxford Circus. Actually, our other customers go here, this is what we recommended, and we've already got you a pre-approved policy of some form. So that's how we started. Then we had the idea of, wouldn't it be good not to have insurance at all, a non-insurance insurance plan. We had this idea of, why don't we have an offset? So you take out health insurance, and in the savings plan, there's zero, and so I've got, I've got no excess, so I'll pay a very high premium. But as I do a forced savings plan, actually the excess is increased in line with the savings plan. And if I have enough money in my savings plan, the premium goes down to zero. And then perhaps a claim comes out of the first part of the savings plan and then eats into the policy. And the third add-on to that would be, when we actually come to make a claim, maybe I can kickstart or crowdfund part of the claims process, or get my church group to come, 20 people to come and build stuff and actually contribute to part of the claims process. That's it.
Okay, Frank, thank you very much. Very enthusiastic. Okay, so last table, Rod.
Okay.
Are we ready? Hang on,
yeah.
ready on the camera?
Yeah, sure.
We're ready.
We've been losing group members quite rapidly. It's been a bit like living inside an Agatha Christie novel. We started looking at the business model canvas as a tool, and we realised that we were looking at it from two different perspectives. So one was, we'd sort of documented the business model of home insurance or general insurance here, and so we were looking at it from one perspective as an insurer, and saying, okay, well, so where are the weaknesses here in our business model? And the flip side was, we were looking at it as entrepreneurs and saying, where are the opportunities to disrupt this existing business model? And the third kind of perspective we took was sort of looking at it from a customer viewpoint, and looking and testing our value propositions and seeing whether our value propositions were well matched to what customers were wanting. So that was kind of the first thing that we learned, that by documenting an existing model, we could then, if you like, approach it from two different directions, and those were complementary, because as an insurer, you could say, well, if we were entrepreneurs, how would we kind of attack this with a disruptive attitude, and then what does that mean for us? How can we possibly reinvent our own business? So just some of the things that we identified in that process. So in the key resources, the data and analytics knowledge, we played that against the list of technologies that were suggested there. And we found that applying most of those didn't directly disrupt the model. So we started to apply them to different parts of the model, and we found that they kind of optimized or increased the efficiency of different parts of the model, but without fundamentally disrupting it. So we started thinking about how we might, for example, alter our partnership. So looking at data, we started thinking along the lines of, okay, well, if we had more relevant, more personal, more granular data, how could we use that to change the way that we price insurance or that we structure insurance? So we speculated, well, so suppose Ford came to us and said, okay, all of our cars have got detailed telematics running in them. So every time that car moves, we can tell you where it is, where it's gone, what time of day it is, what the conditions were, the road conditions, who was driving it, how many people were in the car, all of this stuff. So if we can supply that data to you, could you, for example, provide a pricing model that played back the risks that represented, that was different to your kind of standard flat policy? So that was really kind of where we took the business canvas. to just try and explore those different ways of partnering with data providers.
There's basically, there are two specific things that we identified that could potentially be very interesting disruptions that either the insurance industry can use themselves or they can be used by others. One is thinking about an insurance policy as a kind of a general membership thing. So instead of saying, I'm buying a car insurance, say, I'm buying the ability to be insured in something at the moment I need it, whatever that something is. So today I'm cycling, I'm insured as a cyclist. Tomorrow I rent a car, my membership becomes suddenly a car insurance. The day after, I'm facing a different type of risk and so forth. So it's a thing that becomes a very flexible model that allows you to sell very customized risk services, coverage, depending on the situation the person is in. But that depends heavily on your ability to, one, collect data, two, have a different risk model and pricing model that is able to process this data, and three, a feedback mechanism to the person, because that allows the person to make choices as well. So in a model like this, what you can start thinking about is having a basic membership thing, and every change in behavior or circumstances is paid as a premium on top, which allows the person to make a choice at that point. I want to be a risky driver today, so be it. I'm going to pay my little extra for today because I feel like it, and that's fine because it does not impact my overall risk behavior. So that was one of the things we identified as a potential way of disrupting this. Well, disrupting it in a positive way, actually. The insurance companies can use it. The second one is saying, what if you actually run an insurance company as a social business rather than as a for-profit business? What would that bring? So the whole concept that is developing in the crowd and all that world, social world, why can't actually a business do it and run it as a social enterprise? And if somebody does it, then what would consumers do? That's really the big question. So that's the two big ideas we really came up with.
Okay, brilliant. Thank you very much. Thank you, Rod and the team. Okay, so I think we'll just close it there. We're going to do a few things now. We're going to photograph these second trees.